Seeds of Wisdom Team Newshounds. Yeah, 2008 was a wild ride, right? Banks were giving out mortgages like candy on Halloween, even to people who definitely couldn't afford them. These risky loans were bundled together and sold off as fancy investments. But guess what? They weren't so fancy after all. When those mortgages started defaulting, the whole system went kaput. Banks lost billions. People lost their homes. It was a mess. It turns out letting banks run wild with little oversight is about as smart as letting a toddler loose in a china shop. You're just asking for trouble. So, after that whole debacle, the world's financial bigwigs decided enough was enough. They needed a way to prevent another meltdown. Enter Basel III, the superhero of banking regulations, here to save the day and our wallets. Imagine Basel III as the no-nonsense bouncer of the global financial system. It's got its eye on all the banks, making sure they're not getting up to their old risky tricks. This set of international regulations was born from the ashes of the 2008 crisis, crafted by the Basel Committee on Banking Supervision. Catchy name, right? This committee, made up of central banks and regulators from around the world, basically said, okay, we need some serious ground rules here. No more playing fast and loose with people's money. They wanted to make sure banks were strong enough to withstand any future financial storms. Basel III is all about building a more resilient and stable banking system. It's about preventing another 2008, and trust me, nobody wants to relive that. One of the main ways Basel III keeps banks in check is through capital requirements. Think of this as the financial cushion banks need in case things go south. Basically, banks have to hold on to a certain amount of high-quality assets like cash or government bonds. This acts as a safety net. If a bunch of loans go bad, remember those subprime mortgages, the bank has a reserve to absorb the losses without going belly up. The higher the capital requirements, the stronger the bank's defenses against financial shocks. It's like wearing extra padding when you go skateboarding. It might not prevent all falls, but it'll definitely soften the blow. Section 4. Liquidity ratios, keeping cash flowing. Now imagine a bank suddenly facing a massive wave of withdrawals. Everyone wants their money at the same time. Yikes! This is where liquidity comes in, and Basel III takes it very seriously. Banks need to have enough cash on hand to handle these situations without breaking a sweat. That's where liquidity ratios come into play. These ratios measure a bank's ability to meet its short-term obligations, like customer withdrawals. Basel III sets specific requirements, like the liquidity coverage ratio, ensuring banks have enough high-quality liquid assets to cover a month of significant stress. It's all about keeping the cash flowing, even in a crisis. Section 5. A safer future. Why Basel III matters. So why should you care about Basel III? Well, it's all about creating a safer, more stable financial system for everyone. By strengthening banks, we reduce the risk of another devastating financial crisis. And that means more security for your savings, your investments, and the overall economy. Think of it this way. Basel III is like the building code for banks. Just like we have rules for constructing safe and sturdy buildings, we need regulations to ensure our financial institutions are built to last. Nobody wants to live in a house built on shaky foundations, and nobody wants a financial system that could crumble at any moment. Section 6. Net stable funding ratio, long-term stability. Okay, we've covered the short term, but what about the long haul? That's where the net stable funding ratio comes in, another crucial part of Basel III. This rule ensures banks have a stable funding base to support their lending activities over the long term. Think of it like this. You wouldn't want to build a house on sand, right? You need a solid foundation. The NSFR makes sure banks aren't relying too heavily on short-term, flighty funding sources. Instead, they need to focus on more stable, long-term funding, like customer deposits. This promotes more sustainable and responsible lending practices, which ultimately benefits everyone. So there you have it. Basel III might sound like a snooze fest, but it's actually pretty important stuff. It's all about keeping our financial system safe, sound, and dare we say boring. And in the world of finance, boring is good. Really good. Seeds of Wisdom Team Newshounds. Do your own research. Please subscribe and follow Seeds of Wisdom Team. They care about facts.